In this episode of the Weekly Stock Update, we have HIMSS releasing their earnings, which investors did not like what they saw, and so the stock started to crash a little bit. We also have Cerebras IPO, which got a lot of people excited, but I'm going to send a few warning shots that might make you wary of actually buying the stock. And then I'm also going to give an update on my $100,000 challenge, week 50. Let's get into it. All right, everyone. So this is my weekly stock update video. Let's talk about HIMSS earnings, Cerebras IPO, and this is week 50 of my $100,000 challenge. So if you can, please give me a like and subscribe. I really appreciate it. HIMSS earnings. Let's see exactly what happened. 4%. The revenue went up only 4%. I'm just going to get right into it. Only 4% it went up in the revenue. The gross margins went down 65% compared to 73%. They had a net loss of $92 million. This is probably the biggest one. Revenue and the net loss. They lost $92 million compared to a $50 million profit last year. The adjusted EBITDA was down from, it went to $44 million from $91 million. The net cash was $89 million compared to $109 million last year. The only positive was the free cash flow was $53 million compared to $50 million last year. So why, right? What's going on? What happened? I'm going to explain that really quick, but I give their income statement a D grade, and that's because the revenue went up only 4%. You can see it went up only 4%. The cost of revenue went up 36%. The gross margins went down 8%. You have your general and administrative going up 126%. The only good thing is the marketing went down 4%. And the net loss, it wasn't income, lost $92 million, and their EPS was negative 40 cents. Wall Street had them estimated at basically 3 cents, between 2 and 4 cents positive. They did not do that. So it was not a good release for HIMSS, but there's a reason why it's so bad. I'm going to get into that in a second. The last time they released their earnings and they reported a loss was 10 quarters ago. It was 2.5 years ago, September 2023, right? They recorded a $7.6 million loss. So again, that's not good. This is a big thing right here. One of the reasons why the stock went down a lot, but also just let me show you something really quick. They put down 2025 twice. This is a typo that I never want to see again, and it should never ever happen. They literally, if you look at this one, I didn't cross this one out. What if you just showed this to someone? You wouldn't know which one's which, right? This is actually 2026. Now, it's just bad. So anyway, 2026, 2025. The subscribers went up 9%, but the monthly revenue per average subscriber went down. So they're making less money per average subscriber, even though they're gaining more subscribers. The United States revenue went down 8%. That's one of the biggest reasons why the stock was going down, is because they don't want to see that. Gross margins are going down, and the revenue only went up 4%, and that's because the United States revenue went down 8%. Now, the rest of the world did go up about 1,000%, right? Went from 7.3 million to 78 million. That's great. Hopefully, they're going to continue on a really good growth path with the rest of the world, and that's going to help their balance. It's going to help everything, the revenue, all of that. But to see the rest of the, or to see the United States revenue go down 8%, that is just, that's horrible. But why? Why? Well, Novo. They made the deal with Novo in the beginning of March. They got sued. They released their pill, and then they got sued in the beginning of February. Most of this first quarter was a transition process of going from your compounding and you're pushing your way of doing things to now you're in this lawsuit. And during the lawsuit, like once they got sued, they immediately got on the phone and started doing business, right? And started like figuring out how they're going to do it. And so that the restructuring probably started happening very fast. And I say this because within a month they got a deal. So from being sued and going into a lawsuit to then having a deal, was it like a month. So they were moving quickly on this, which means they had to pull away a lot of things. And so they had to change how they're doing stuff. So this quarter was just bad. But the fiscal year, they have projected $2.8 to $3 billion for the whole year, which would be 19 to 28% increase. It's not the numbers we're used to seeing because, when the bigger your business gets, the harder it is to grow at that rate. But again, they're going through this kind of transition right now. So there's that transition, right? It kind of sucks, but whatever. 2030, their financial targets are $6.5 billion and $1.3 billion of adjusted EBITDA. So the revenue has not changed, and neither one of these numbers has changed. They still believe they're going to make $6.5 billion by 2030. It's their financial targets, and they've been saying that for a while now, and they've not stayed away from that. So that's good. Rest of the world, it's up 10x, right? Basically almost 10,000 or 1,000%. The Zava and eucalyptus is going to help tremendously, and those numbers I don't think included eucalyptus. They had a lot of numbers in here that said it did not include eucalyptus. So that's going to be good to see what the next one is. Peptides. We don't all know, I guess. Peptides, though, are kind of like the HIMSS next phase, right? A lot of people knew HIMSS as like a ED, right? Erectile dysfunction pill or company. Then they, with the GLP-1s and stuff, now they're like, oh, they're the weight loss company. They're the GLP-1 company. The CEO, Andrew Dunham, he actually did a podcast, and he straight out basically admits that HIMSS is going to be big on peptides. And he says it because it says, right now they're seen as a GLP-1 company, but then they're going to be seen as a peptides company. So I'm going to play the clip, and he just says it straight up basically himself.
We launched GLP-1s, and everyone said, oh, now you're just a weight loss business. And, a year from now, people will say, oh, you're just like a peptides business, probably, if I were to take a guess.
So yeah, basically, you can expect HIMSS to be selling peptides and be one of the major drivers in peptides. Well, the good thing is the FDA actually just came out, and they're having a meeting to see if they're going to be allowing compounding pharmacies to manufacture certain peptides. HIMSS, this is what they're all about. Now, 7 of the peptides are going to be the focus on the meeting for July 23rd and 24th, and then another 5 peptides will be up for discussion in February 2027. But it is most likely going to happen where these peptides get reclassified, and then these companies can start compounding them. HIMSS is going to benefit big on it, and they're already preparing for it. This is the interest in peptides in the last 5 years. As you can see in the last year, from 2025 and beyond, it's really gone up. Peptides are a healthier version. They're a better way of getting these, I don't want to say drugs exactly. The peptides is like a natural amino acid. So it does these things, and it's hard to explain really quickly, but it's a lot better for you. Your body responds to it a lot easier. It's a natural form. It's not chemically made. So it's really good. And so I think that it's going to be very big for HIMSS, and it's very popular right now. It's actually currently going under a massive gold rush. Right now, the market is between 80 billion to 140 billion. They projected to reach 295 to 335 billion in about 10 years. So that's a pretty big jump, and HIMSS wants to be the major driver, the major, producer and, beneficiary from that. HIMSS is down 62% in the last 288 days, right? That's pretty bad. 62% in 288 days since July 25. I mean, we're talking almost a full year now, and you're down about 60%. This is why my $100,000 challenge isn't doing so well. But I believe I've added to my portfolio. I'm still confident. But as of right now, HIMSS is down significantly, obviously, since the $15, $16 mark right before when it was in the lawsuit. And before the Novo deal, yeah, obviously, you're making a profit, but most of us are not. So this is kind of how I see maybe the stock going. I think, all right, this is so much drama. Okay, we're over it. We're over the drama. The FDA is going to have a meeting. July is going to come around. We're just going to keep bouncing up and up and up. I think it's going to be okay. It's just sometimes you got to take some pain with it. Is Cerebras a legit threat to chip companies? We're going to quickly go over what is Cerebras, what is this company. It's an AI chip maker, and it soared 68% in their IPO. It is a Silicon Valley maker of AI chips, right? Let's talk about what happened with the stock price, because that was kind of the big news. The IPO price was 185, but the opening price was 350. This is very important. The first day close was $311, up 68%. And if you look at 350, when you look at 311, you're like, well, that's not up 68%. You'd be right. That math is not mathing. 185 plus 68% is going to be 311. The reason is the IPO price is where Wall Street, hedge funds, people with a lot of money, they're able to get to the IPO price before it's out to the public and just on the brokers, right? Just on the market. So for all of us who didn't have access to the IPO, the first price we saw was 350. That was the first price we were even able to have it. So for most, if actually all retail investors who did not have access to that IPO price, you're down already. You're down. And this is what I was going to say. There's a warning that I have for IPOs, especially hot ones like this. But let's get into exactly what is Cerebras, right? It says right here, kind of blurred out a little bit, the world's biggest chip. I mean, this is literally how big their chip is. They are an American semiconductor company that designs and manufactures high-performance computer hardware engineered for AI, right? All right. They have how their technology works. They have a wafer-scale processor. Unlike standard chips that are cut from a silicon wafer, Cerebras uses an entire 12-inch silicon wafer to create a single supersized processor. They have an unmatched scale. Their flagship Wafer-Scale Engine 3 packs 4 trillion transistors and 900,000 compute cores. Nerd. No, I'm just kidding. It is roughly 58 times larger and performs AI inference up to 15 times faster than the standard GPU-based solutions. And also the SRAM advantage, they use a static RAM etched directly into the silicon, which operates significantly faster and requires less data traveling time than networked multi-chip systems. All right, cool. So right now you can see that they seems like a good product, right? A very a superior product in a sense, right? Major partnerships in cloud services. Well, they just got an OpenAI deal. OpenAI committed $20 billion to rent 750 megawatts of AI computing between 2026 and 2028. Amazon Web Services also plans to deploy Cerebras chips alongside its proprietary Trainium chips. And then they also have a cloud platform, kind of like Nvidia, where they offer a commercialized cloud computing platform that lets developers run AI applications using their wafer-scale processors. So that's just kind of like what they do, right? Or what the product is. There is something that's a little, that would make me very hesitant about this company. The customer concentration. The revenue actually, the intake has been historically dependent on a very small number of clients. In 2025, roughly 86% of their revenue came from just 2 customers linked to the UAE. So you got 2 customers making up 86% of your revenue last year. Well, in 2026, they did strike a massive deal with OpenAI, like we just said, for $20 billion over the lifetime, so that is going to help. And then AWS and Defense, Cerebras, they signed the deal with AWS, right? So that's going to help. But they're still very dependent on those 2 customers, and that's a little, that's what their numbers are based off of right now, right? So Cerebras stock, it falls 10% in the first full day of trading. So this is after it had the IPO and then the open, so it was at 311, so it dropped another $30 or so. Cerebras stock slides after explosive IPO, 2 reasons to be wary. Cerebras, don't buy the IPO hype, wait for a drop. Cerebras just pulled off the biggest IPO of 2026 so far. History says this happens next. So here's the warnings. History suggests that buying an IPO this big at the opening trade is a tough way to make money. The newly the newly public formed companies from 1980 through 2024 have underperformed smaller sized firms by an average of 3.6 per year during their first 5 years in the market. For IPOs since 2010, the first year shortfall has been even sharper, with a 9% point gap versus comparable non-IPO firms on average. So essentially, you could say for the first year, this company is going to have at least a 9% or more, or a roughly 9% difference than the market, right? It's going to underperform about 9%, historically speaking, right? Well, if we look at just since 2020, I said, hey, let's go over the top 10 IPOs that happened. Well, we see over here at the bottom three, they kind of messed up. They put these numbers, they switched it over a little bit. But these numbers are correct. And if you look at the IPO price, like I said, the IPO price is not the public price. The open price is when you're getting it. And then you look at the current price, right? Now, when you look at the versus IPO price, what the current price is versus IPO, we're half and half. If you bought the IPO, if you bought all of these at the IPO, you're half winning, half losing. If you bought all of these at the open, only one is a winner. That's the difference. That is a significant difference. And it's not just your winner. Going down 8-9% to going up 95%, big difference. This is why these Wall Streeters, the hedge funds, and the why the rich get richer in a way, right? Because you have access to this, and your returns are so much better. Even if your returns are negative, negative 21% is better than negative 32%. It just is a lot better. So just be careful when you're with the IPOs, and it's a big company. People are going to flood into it, and then people are going to flood out. And so just be careful of it and be aware. All right, now for a stock market update. Let's get into the stock market in general. Over this last week, Nvidia and Apple had a pretty good week. MU had a good week. Energy, minerals, and industrial services had a good week. The bad, Amazon didn't really have, they were negative. Producer manufacturing and utilities, customer services, those were all pretty red. And then we also have GE and Qualcomm, also pretty red over there. So, kind of a mixed bag, but nothing crazy. S&P 500 retreated from the all-time highs, but as you can see, it's up 17% in 46 days. The NASDAQ, again, retreated from the all-time highs, but up 26% in 46 days. The Dow Jones, it still didn't even reach its all-time high recently, but it's up 9% in 46 days. And then the Russell 2000, that's probably 46 days, but 16% in about 46 days, and it's also retreated from its all-time highs. So the indexes have all retreated from their all-time highs, basically, right after reaching it, and they're all kind of in this forward momentum, right? So let's kind of break it down. The AAII Sentiment Investor Survey, we have the bulls kind of just staying firm, 38-39%, not moving. The bears, you can see they kind of bounced around a little bit, right? The neutrals kind of bounced around, so it went from 22 to 28, 24. So, the bulls are staying firm, but the bears are kind of bouncing. This is something very interesting. I really want you to pay attention to how emotional the stock market can be. This is May 15th. This is today. Well, I guess is today May? Yeah, today's May 16th. May 15th. This was Friday. I'm gonna go back 2 months, but look at this. Today, greed. A week ago, greed. A month ago, greed. A year ago, greed. What was it like 2 months ago? Extreme fear. A week before that, extreme fear. A month before that, fear. A year ago before that, extreme fear. All I'm going to say is when the market is fearful, you got to get greedy. And when the market is really greedy, it doesn't mean you necessarily have to get fearful. I'd say when it's extremely greedy, then you need to get fearful. Never be too fearful of the market, but you definitely need to know when to get greedy. And if you got greedy in March, you probably have made some profits, right? Some, right? I mean, Hims has done a little bit. But the point is, the market is emotional. Don't let the market drive your emotion. Let the numbers drive your emotion. Find good quality companies that make good money, good income, and you know what they're about. And and the stock also kind of goes with the business, right? Because you can sometimes have stocks and businesses diverge, right? The stock can be bad, but the business is good, or the business is kind of good, but the stock is doing way better, right? You want to make sure that's like, okay, like I want the stock can be on the lower side of hasn't performed very well, but the business is performing very well, and eventually that stock will catch up, right? If you can find a company like that. So last week's news, let's go over what happened last week in the stock market. We have inflation fears and surging treasury yields. So the high consumer price index readings and unresolved US-Iran conflict pushed the oil prices again past $100. This energy spike sent the 30-year treasury past 5.1%. And the signs of accelerating inflation rattled investors. And so it's making the Federal Reserve, it's basically he's going to keep the interest rates elevated, right? This is the 30-year treasury. And if you look at it, it hit 5.1, like, okay, yeah, I mean, that's definitely, it's gone up since March, but that's like with everything, right? Well, look at what the 30-year treasury trend was. Since we're talking, look, this is the 1980s, people. We're talking the late 70s, early 80s. Look at this thing was going down all the way. Continued, started to taper off a little bit more, obviously. But then once we hit COVID, ever since then, it's been on trail up. Now, this doesn't mean the stock market's the stock market did go down in 2022, but this is a very interesting chart to see. When is this thing going to get pulled back? I mean, this thing is hitting now 2007, 2008 levels, right? It doesn't mean that things are going to crash like that. It's also going back all the way to, 1998 levels. 1998, 1999 levels. So it's just something to be, looking at a little bit. This is the inflation. As you can see, we have now reached, this was 2022, the peak inflation. We had horrible inflation. Well, when we got out of that, we haven't hit these levels since until today. With the war and everything, we can really see, inflation is actually kicked up, and it's kicked up tremendously. I mean, it's gone from 2.3 to 3.8. I mean, that's a big jump in inflation quickly. The number two thing that happened last week, AI chip maker Cerebras surged 68% on its IPO. We already went over that, of course. So, and then obviously technology equities remain the market's core engine. So, technology is just running the stock market right now. Then we also have Trump and Xi, their meeting. It completed a high-stakes two-day diplomatic summit. The summit secured an immediate aerospace and technology business wins for companies like Boeing and Nvidia, but they ultimately failed to deliver a highly anticipated mega deal, which people were talking about. But I just put it's another deal that hasn't been made, right? We got Iran, we got this, we got that. It's just who knows what's going on, but the world is moving along. Next week's news. What's happening next week? So Nvidia, they high stakes earnings, right? They're going to be releasing their earnings on May 20th after hours. So investors are going to be looking to see if the massive spending on graphics on the GPUs and optical communications architecture translates into resilient corporate balance sheets. Well, let me show you one thing. This was their last earnings. Okay, this is their previous earnings. Their year-over-year growth, when you see the revenue, they had $68 billion, a 73% year-over-year growth. Their net income was $42 $2 billion, 94% year-over-year growth. Their earnings was $1.76, 98% year-over-year growth. Stock must have gone up. It went down 15%, 33 days after reporting the earnings. This was the Iran war. That had a lot to do with it. But Nvidia doesn't get really affected. I mean, of course, there's just a lot of concerns and the market in general is going to go down. Therefore, Nvidia went down as well. But, it went down regardless. And so, yes, they're going to release their earnings. I have a feeling they're going to come out with stellar earnings, blowout earnings. They're going to be great. But you just don't know how the stock market's going to respond. Again, this was kind of at a time where we were already in the midst of the war and stuff like that. But still, that doesn't make any sense, right? And then we also have the retail giants. They're going to shed some light on the lower end consumers. No, I'm just kidding. Major retailers, Walmart, Home Depot, Lowe's, and TJX companies will report earnings throughout the week. I guess yes, lower end consumers. I don't shop at Walmart. I guess Home Depot. I shop at Amazon. So I don't know. Would that be? Is Walmart and Lowe's and TJ, are they really that much cheaper than Amazon? If they are, then maybe I need to start saving some money because my kids are growing fast. The expected impact, these financial results offer immediate clarity on consumer financial stability under persistent inflationary headwinds. And so the high fuel costs and elevated prices are creating a stark divergence between the higher income households and those living paycheck to paycheck. So we're going to see, again, we just got the inflation report. So it's like, okay, well, what's going to happen when they report their earnings? And then we also have the Fed minutes. They're going to release their minutes on May 20th. And alongside the April housing starts and building permits data. So following a week of surging treasury yields and hotter than expected inflation, the market is highly sensitive to hawkish central bank rhetoric. So again, the market's going to be listening to the Fed, what they're talking about. It might be a rough week because we don't really have any clarity. Earnings season is basically over, right? We have the inflation kind of popping up and we have this transition into, going into the new Fed chair. So it's like, what exactly is going to happen? Earnings, the next earnings that are coming up this week, we went over a few of them: Home Depot, Target, Lowe's, Walmart. And this company is, this company is not important. No, Nvidia, that's going to be the big one to watch, obviously Wednesday after hours. All right, so to my $100,000 stock market challenge, week 50. I am almost at my year one, and so I'm excited. I'm a little bummed, but I'll go over why. $9,129.88. So this is my portfolio right now. I have come to the conclusion I need to consolidate a little bit. Now, if I had consolidated even more into HIMS or Celsius, I'd be down even more possibly. But I need to make a decision here. These top five I like. My TQQQ, HIMS, Celsius, Meta, Amazon. I'm keeping all of these 5 positions. They're all double-digit positions in terms of weight. This TQQQ started off at $600 and now it's at $2,200 basically. No, that doesn't seem right. I think it was at $1,000, somewhere around there. My cost is $21 and then I have, what is that? That's like $600, right? But anyway, I just really don't want to sell any of these. Now I need to consolidate CRM, Adobe, Oddity, Now, MU, and Google. MU, I'm kicking myself because I knew that was going to be a good one. I should have added more. I bought it at 402. I'm up almost 80% on it. And I bought a 0.12% of the stock. So I'm looking at their numbers. I thought their numbers looked great. It was almost too good to be true. It looked too good to be true. MU looked too good to be true. It just didn't, I was like, it doesn't make sense. But it does. I think it does make sense to get MU. So I think I'm going to buy some MU I think what I'm going to have to do is I think I'm going to sell my Adobe, sell my Oddity, sell my Now, and sell my Google. And just start piling into MU and CRM. Like those might be my two stocks that I start buying. CRM is going to be my SaaS play. MU is going to be my chip play, my technology play. Amazon and Meta are going to be my Magnificent Seven plays. HIMS and Celsius are going to be my retail, consumer, outside the technology play. And then TQQQ is obviously just pure technology. So that's what I'm thinking I'm going to be doing here soon. As you can see, I kind of went on a buying spree of Celsius. I went 1, 2, 3, 4 times I bought Celsius. I bought Salesforce 2 times. I sold my Nike, sold the rest of it, and I sold my trade desk. Again, consolidating, getting rid of some losers that I just don't think are going to be able to grow as fast as a Celsius or a Salesforce. And I did buy a ServiceNow, but like I said, I think I'm going to have to sell and put that into Salesforce, put that into MU, probably. $9,129. My goal was to be at $11,490. So the weekly change, I was at 94.84 last week, so I'm down negative 3.74%. Against this goal, I'm down 20%. Since June 2nd, 2025 is when I started this goal, I'm up 24%. But if you take away all my deposits that were $50, I'm down 15%. That's a big difference, right? Now, obviously, the $50 per week that's $2,500 at least. Plus, I put another $400, so I'm at $2,900. So, yeah, it's not the best, but I think I'm gonna be better. HIMS really ruined it because when I didn't ruin it, but I started my position June 2nd, 2025. The challenge started when HIMS was at like 50 or 52. When I started this challenge, I knew immediately saying, hey, like this is going to be something that hurts my challenge and my position here over the next year or two, probably, or my goal. But I think once HIMS and Celsius, these ones pick up after the next year or two, that's when it's really going to accelerate a lot. I already had the stocks at a pretty low price. I'm not playing the trading game. I'm not trying to buy, sell too much, right? I'm trying to buy more. Those Nike and Trade Desk selling, I sold them off. I don't sell the stocks very much. I don't sell my stocks. So I'm consolidating. I just more want to buy consistently. And so again, having consistent deposits really matters. It really does. It can make a big difference in your portfolio. So thank you for watching. I really appreciate it. Please give a like and subscribe. It does a lot for the channel. It really does. I am tired. It is late. It is almost midnight. I had work today and I got the 2 kids. I hope you guys appreciate this because I'm trying to do as much as I can, and it is not easy, but trying to hustle, trying to do everything I can because we all got to try to survive in this world, because I am one of those paycheck to paycheck those. I'm not in the higher income bracket right now. I'm not getting the IPO price is what I'm trying to say. I'm one of the retail investors. So trying to do everything I can to keep you guys up to date, keep myself up to date, improve myself. And, I take suggestions and I love opinions and all of that from everybody. So thank you for watching. I really appreciate it. And never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities. And you can count on compounded interest.